Hi, this is Jim Lee of StratFI, and I'm here to walk you through our market update for the beginning of February 2016. We'll be going over some charts and graphs here, so you might want to go to full screen mode to see all the details. Right now, we're seeing something of a push and pull in the markets, with earning reports pulling prices down and overseas central banks pushing the dollar and U.S. stocks back up. And this is all part of what could be called almost a zombie economy. It's not really among the living or the dead, but just kind of shambling along mindlessly and without direction. So at this point, we're not currently in a recession, but also not experiencing significant growth either. There is no doubt about it. January was just a tough month for investors. As you can see here, stocks have been in a long-term uptrend for about 5 years now, but stock prices really started to hit a ceiling last summer, as you can see here. This uptrend has been broken, and we've actually started to see some bear markets in a number of places, including the emerging markets, Japan, and also small cap stocks. So up to this point, the S&P 500 has been one of the better places to be for stocks, even at roughly a 12% markdown from peak prices. Now, if the recent lows do hold, we may stay in the 1850 to 2150 range for the next few months. My best guess is that if lows don't hold, stocks may move down to the 1750 level before they start to see another round of support. I'm not seeing annual double-digit percentage gains for the S&P 500 really until about 2018 at the earliest, but I also think that there's a decent chance that we'll end the year slightly above where we are right now. Most people would say that stocks are short-term oversold, which you can see in our momentum indicator down here to the right. This type of situation has traditionally provided for some good buying opportunities, but unlike the oversold conditions that we've had in the past, including last summer, this time I'm actually a little bit more reluctant to take the bait. And part of that really comes from our economic indicators. One that I follow here, it's called the PMI index, which in my opinion is one of the better leading economic indicators out there, typically with a lead time of about 4 to 6 months. And what this is a survey of purchasing manager activity for large organizations. Any reading above 50 shows expansion in manufacturing activity. Any reading below 50 shows a contraction in activity. And this has been happening really since November. And you can see here that multi-month dips below 50 are often, but not always, confirmed by a recession within the next 6 months. So if the ISM drops below 45 from its current levels of 48, then the likelihood of a recession goes up to 85%. Right now, the likelihood of a weak recession is actually much closer to 50-50, so it's a coin toss at this point. So this is our market map for the month of January. It's very easy to read. Green is good and red is bad. The big boxes represent big companies, small boxes represent small companies, and you can see that there really weren't that many places to hide last month, save for in defensive stocks such as telecom. Here we have AT&T and Verizon. The consumer staple stocks, Procter & Gamble, Clorox, Kimberly-Clark, slightly positive for the year, and also utilities, which really have been the best performing segment of the market, and that's something that you'll also see here. So here we have the performance of various sector ETFs, both since November and also year to date, going through the month of January. You can see that since November, pretty much everything was off except for, again, those consumer staple stocks and utility stocks. Materials and energy off hard, although we're beginning to find the energy stocks show some signs of bottoming out, which I find very interesting. Going on a year-to-date basis, We're also seeing a decline in relative performance for the financial stocks. This is, I think, something that suggests to me that we need to start looking at credit quality. There are some risks here associated with junk bonds, for example, and debt coming out of the energy sector, which I think are worth taking a look at. So here we have junk bond yield spreads relative to long-term U.S. Treasuries. So what we do is we take a look at junk bond yields, subtract the yields of U.S. long-term Treasuries, and what we get is something called the spread. You'll see that this spread now is at the highest level that we've seen since the debt crisis. Usually, rising spreads indicate a lack of confidence in a junk bond issuer's ability to pay back. And higher spreads mean lower prices for junk bonds. Sometimes as an investor, you're happy to get a return on your money. In this case, it looks like investors would be happy to get a return of their money as well. So from what I can see at this point, there's really no reason to hold junk bonds in portfolios right now. So in terms of getting the timing right, we have too hot, too cold, just right, and sort of the too late category. Junk bonds are certainly in that position. They did well for years and years. At this point, I think that people need to get out. The too early category, I think that petroleum prices are close to bottoming out. And with that, we may see a very good entry point for emerging market stocks sometime within the next 6 to 12 months. But we need to see some bottoming in commodity prices before that happens. So small cap stocks have also been underperforming for the past 3 years, but they're starting to show some good relative valuation. Coming out of recession, going into recovery, small cap stocks do tend to outperform the blue chip stocks. So if we're going into recession right now, I'd say it's a little bit too early to load up on small cap. Coming out, that's an area that you're going to want to have some exposure to. So in the just right category, our sector rotation strategy is in utilities and consumer staple stocks, both traditionally fairly defensive sectors to be in. And on the technology side, we've had a lot of Internet of Things exposures, semiconductor stocks. Basically, the Internet of Things is about connecting the physical world to the internet wirelessly. That may include our homes, our cars, even to a certain degree our bodies as well. There's wireless power transmission, which I talked about in our last update. That's the ability to charge small devices or transmit wireless energy over short distances, which I see as a big trend. It's actually worked out fairly well for us. And one that I've talked about in the past as well, which is OLEDs, short for organic LEDs. These are thin film displays, which can be made to be transparent, flexible, energy efficient, high contrast. It's really the next stage of display technology, and it's beginning to hit prime time right now. So very exciting to watch. I see it transforming multiple industries, from wearables to lighting to even augmented and virtual reality. So interesting stuff worth taking a look at. Now, we may be in a flat, albeit volatile market for the next few months. So these are some strategies which may work in this type of environment. Diversification has not worked really for the last 2 or 3 years, but so far for 2016, diversification has been working out pretty well. And that involves holding a combination of stocks, high-grade bonds, cash, and even gold has been contributing to returns this year. Sector rotation is a core strategy that we use for many of our clients, which involves focusing on those segments of the market that are outperforming and staying out of those segments of the market which are underperforming. And as I've said, this strategy has been focusing more recently on utilities, consumer staple stocks. Once those areas stop working for us, we're going to move out and we're going to move into things that are doing better for us. We also do a lot of work looking at what are called smart beta strategies within the exchange traded funds, also known as ETFs. These include strategies that focus on corporate revenues versus market cap, for example. This type of smarter way of indexing has provided better downside protection in the past than a conventional index such as the S&P 500. We also look at dividend-focused ETFs, including DIVY and SYLD, and also for conservative accounts, exchange-traded funds that are focused on building low volatility portfolios might also make some kind of sense here. So a few things that you can do. Again, be careful on your fixed income exposure. Try to keep your credit quality up. Having some cash on the sidelines certainly doesn't hurt. We may have a short-term buying opportunity for here with stocks, but I'd be careful about that at this point. And stay tuned and continue to look for growth. So thanks again for your time. We'll catch up again soon. Bye-bye.